Okay, so I've been told by a viewer that this is kind of like my signature move now, i.e. saying okay and raising my arm like that. So I guess every YouTuber needs a signature move, kind of like a Pokemon. But anyways, today we're going to be talking about Spacs, which stands for Special Purpose Acquisition Company. Now these have become super popular lately, and I'm just going to talk about them and share some of my thoughts in today's video and talk about how as investors or as just retail investors, we could potentially use this tool to help us achieve our goal of financial independence and retire early. So I'm super excited for this video, and without further ado, let's jump in. So first of all, what is a SPAC? Well, for those of you who need a reminder, basically a SPAC is what we call a blank check company, and basically it's a shell company that is publicly traded, and the purpose of this company is to merge with a private company, and the purpose of doing that is to bring that private company public. So it's just like a way of doing IPO, i.e. like you merge with a company to do an IPO rather than directly listing your shares on like New York Stock Exchange or whatever, right? So sometimes these are called merger IPO companies, right? Or people call them merger IPO. So if you ever hear about that, that's what it is, right? Or sometimes they're also called SPAC IPOs. So you can think about it as just an alternative way for you to do an IPO, right? So, as I said earlier, if you recall how a traditional IPO works, basically you would either list your shares directly on an exchange, or you would file some paperwork and find like an underwriter, they call it, which is a investment bank like Goldman Sachs or Morgan Stanley or something, and then they would buy the shares from you and list it with them. And then, basically they're going to help you with the IPO process. So that's the traditional way of doing it. But with a SPAC merger, it's a little easier in terms of paperwork because it's technically like more of a merger rather than a traditional IPO process. So if you recall, as we mentioned earlier, once again, the SPAC is already publicly traded. So all you have to do is merge with that SPAC, and then the deal is done. They change the ticker, and then you become a public company. So yeah, this is actually a great time to be talking about SPACs because recently we just got the news that IPOB, which is a SPAC that was founded by Chamath, and I'm not going to try and pronounce his last name. Everyone knows him by Chamath anyways. So IPOB is merging with a company called Open Door, and basically it's a real estate company that's been super popular lately. And I'm not going to spend too much time talking about Open Door in this video, but if you want, I'll make a separate video on Open Door. So if you want to see that, please leave that down in the comments below. But anyways, another bigger advantage of doing a SPAC IPO as opposed to a traditional IPO, besides maybe the paperwork being a little easier, is that the company who wants to go public will get an immediate injection of cash up front. Right, so most SPACs are maybe in the range of like hundreds of millions of dollars, and we'll talk about one later that is $4 billion. And for some of you finance nerds, you can probably already guess which one that is. Can you guess out, by the way? Anyways, these SPACs, when they merge with whatever company, they're actually taking, whatever the full amount of what a SPAC is worth, and they're injecting it into the company, right? They're buying like a minority stake in the company that wants to go public. If none of what I said just made sense, don't worry about it. Point is, this method of taking companies public has become super popular recently. And I know that SPAC mergers kind of gained a negative connotation recently just because if you recall, this is how Nikola went public. So if you recall, Nikola actually went public through a SPAC deal with a company called Vecto IQ Acquisition. And, in the first video I ever made about Nikola back then when they were still trading as Vecto IQ, ticker symbol VTIQ, in that video I made a mistake. I called it Vector IQ by accident, but no, it's actually Vecto IQ, so apologies for that. But yeah, we all kind of knew how the Nikola deal went down, and we all knew what kind of company Nikola turned out to be, right? So I can see how like some people might have a negative connotation. And at the time, many people, including myself, believed that Nikola chose to go the SPAC merger route just because it's a little easier, and arguably there's less scrutiny that's going to be put on the paperwork compared to if they were to do a traditional IPO. So, in the beginning, I kind of thought it was kind of shady how they used a SPAC deal. And it's another sign that the management was trying to like cash out and take the company public as soon as possible so that they can cash out. However, with that being said, my views on SPACs have evolved since then because I realized, a SPAC merger, as opposed to a traditional IPO, it's just a tool in the fantastic world of finance, right? So, it's not inherently good or bad. So it's just like any technology, right? So it's like a kitchen knife, right? You could either use it to cook food or you could stab somebody with it, right? So, the knife itself is not good or bad. It's just, it depends on how you use it, right? It depends on who it is, and you really got to look at it on a case-by-case basis. So as some of you know, I am invested in a company that is going through a SPAC merger right now, namely Hyliion. So in my opinion, Hyliion is legit. They didn't roll their truck down a hill and like film it and pretend that the truck could power itself, because Hyliion trucks can actually power themselves because they actually work. So my point is, I think that SPACs are actually a fantastic tool in the financial world and has many benefits for small retail investors like you and I that otherwise we wouldn't get from a traditional IPO, right? So what do I mean by that? Well, recently, if you recall, I made a video on Snowflake, which is this really popular software company that recently did their IPO, and there's a lot of hype surrounding it. So be sure to check out that video on Snowflake if you haven't already. But anyways, to briefly summarize what happened, the stock was supposed to IPO for around $75 to $85 per share, and then the demand was so high that by the time it IPO, they upped the price to $120 per share. And by the time it was open for retail investors like you and I to buy it, the price has skyrocketed to like $270. I think it was trading above $300 at one point, which is absolutely insane. So, as some of you pointed out down in the comments of that video, if you're just some guy on like Robinhood or whatever favorite brokerage you're using, and you submitted a market order for Snowflake on opening day, you would have absolutely got butchered, right? So you would have got screwed. And the reason is that, even though that this is a very high growth company, you're paying quite a hefty price tag at $300 per share. And all the institutional investors like Warren Buffett, the Wall Street insiders, or just company insiders in general, they probably got into the stock for a lot cheaper, right? So if you got into the stock at $300 per share, I hate to say it, but you got absolutely screwed by the big boys. So anyways, the stock has already fallen down to $240 already, and I wouldn't be surprised if it pulls back a little more, just because, after a while, the share lockup period is going to expire, and then the warrants are going to exercise, and then there's going to be dilution. So yeah, I wouldn't be surprised if the stock price goes a little lower. My point is, it's really hard for us retail investors to get in on the game at a good price with traditional IPOs. And, even if you make some gains with trading IPO stocks, I can bet that's not like the big bucks, right? That's chump change compared to what the insiders and the Wall Street people make. So, a SPAC merger does a way better job of just kind of evening out the playing field, in my opinion. And this is because you get a chance to buy into the company before the merger goes into effect. So usually what happens is that they'll announce like a letter of intent called an LOI. So then they'll publish an LOI and they'll announce their intent to merge with whatever company. And then there'll be a period of time before the company actually merges. So, you can buy into that company in that span of time. And then during that time, when the letter of intent comes out, the stock will probably skyrocket by a lot. But then, the stock could still trade a lot higher in between the time they announce the letter of intent and between when the merger finishes, like it was in the case with Vecto IQ and Nikola, and like it is the case with Hyliion and Tortoise acquisition. I can't speak today. And further, I feel like some institutional investors, they might not want to take the risk of investing into a SPAC before the merger deal actually finishes. And this is because that there's a very small chance that the merger might actually fall through, right? So, even though the chance might be very small, from a risk management perspective, I can definitely see why this is the case, just because, we're talking about investment firms or hedge funds that deal with like millions and sometimes even billions of dollars, who deal with like very rich clients. So I can see how they don't want to take the risk, even if it's really small, until the merger actually completes and the ticker actually changes and everything like that. However, that's one of the benefits, I would argue, of being a retail investor like you and me, because we don't have some like fund manager breathing down our necks. We don't have clients breathing down our necks. We invest for ourselves, right? So if you're willing to take on a little bit more risk of the merger deal potentially falling through, which could happen, but once again, most of the time the risk is small. If you do your research properly and you do your due diligence, then we could be the one making money first. So with a traditional IPO, it's kind of like the big institutional investors, they eat first, right? So, a Snowflake is a perfect example where the stock has rallied up to like $300 a share, and it's like they've already made their profits, and as retail investors, it's like $300. Do you want it or no, right? But with a SPAC deal, it kind of flips it around, whereas like us as retail investors, we eat first, and then the institutional investors, they eat later, right? Well, actually, we don't eat first just because I think that the company insiders, they still stand the most to benefit from a deal like this, but at least we don't eat last like how it is with a traditional IPO. Okay, so with all that being said though, what's a strategy that we can devise from knowing what we know now? Well, first, let's talk about how SPACs are set up first. So we know that SPACs are basically just piles of money, right? So they're shell companies. They don't really have any operations before a deal is announced anyways. So typically SPACs are set up in such a way that each share is $10, and then that's kind of the intrinsic value of the share, right? So, if you're buying into a SPAC for $10 a share, it's kind of like you're trading a $10 bill for another $10 bill. So you're not really investing, you're just swapping money for money that's worth the exact same. But in reality, it's unlikely that you'll be able to buy shares at exactly $10 per share because people trade these things, right? So if the management team of a SPAC is well known and people trust them, they might sell at a premium, right? And usually they do. So some people might trade $11 for a $10 bill, and you think that oh, that's kind of stupid. Well, just think that if the management team does good and they find a good merger target, the stock could skyrocket, right? So that's why some people they would pay $11 for a SPAC before a merger deal is even announced. So it doesn't always trade for $10 per share exactly, and in certain circumstances it can actually dip below $10 per share, as you can see here with this SPAC back in March 2020. And the reason for this is just because people, they sell the shares, right? They sell the shares and then they use it to buy other stuff, or they just need the money or something. But generally it should sit around $10 per share. And furthermore, in the beginning when a SPAC is first created, they're sold in what's called units. So a unit is comprised of a common share plus a fraction of a warrant. So, for those of you who are not familiar with what warrants are, no, not that type of warrant. I'm talking about the financial instrument that's called a warrant. It's basically like a call option. So it gives you the right to buy the share of the company at a predetermined price. And in the case of SPACs, it's set to $11.50 by default. So when you're buying units, just keep in mind the warrant fractions. You want to buy the units that are in multiples of whatever the fraction is. And, this is just because you don't want to end up with a fraction of a warrant in the end when the unit splits, right? Because eventually they'll split the shares and the warrants into two separate things. So for example, if a unit is one share and 1/4 of a warrant, you want to buy them in multiples of 4 so that when they split, you end up with a whole number of warrants. I realize half of you are falling asleep right now, so I'll just leave the explanation here. But consider this an introductory video to SPACs. If you want a more detailed video, let me know down in the comments, but I'll leave the explanations there. I want to circle back though to the original question that I was asking, which is what type of investment strategy can we derive from knowing everything that I just told you? Well, that interest rates on savings accounts basically right now are non-existent. So if you want to hold cash, instead of using a savings account, why not just put your money into a SPAC? No, seriously, this is something that you should think about, right? So, you pay a small premium to buy into the SPAC. So, as I said, you might pay $11 for a $10 per share SPAC. Which means that you're paying a 10% premium, right? But, once you do that, there's several scenarios that could happen, right? So the best case scenario, and the one that we want to see, is that the SPAC deal is announced and whatever management team that you trusted your money with, they find a good acquisition target, and hopefully it's going to be a famous company, and then the price will skyrocket and then you make some money, right? So for example, with Tortoise acquisition, we have Hyliion, right? So it started off at $10 per share just like any other SPAC, and now it's trading at 50 after they announced the deal with Hyliion. So if they don't find a target though, then the SPAC will liquidate, right? So when they liquidate, you get back $10 per share. Now you might not get back $10 exactly, actually, just because there might be fees with liquidating the SPAC, so you might not be $10 exactly, but if you bought it under $11 per share, your downside is relatively limited, right? You might lose 10% or something like that, right? You might lose $1 per share. And also you have to pay the opportunity cost of having your money tied up in the SPAC. But my point is that the downside is relatively small compared to the many other things that you could put your money into, like actual stocks, which could obviously go down by more than 10 or 20%. But the upside is huge if a SPAC deal is announced and the company that they're merging with is like a famous company, or it's a really good company or something like that, right? So by the way, this is not financial advice. Don't take financial advice from some random guy on YouTube. That was just like a suggestion. But you know, as I said, you got to keep in mind the risks, right? This is not to say that you should just blindly buy every SPAC that you come across, because some SPACs will inevitably fail. So you still have to be relatively selective in potentially picking a SPAC that you like. And you know, you got to look at the management team, and you got to look at what the purpose of the SPAC is, right? So some SPACs are focused specifically on, let's say, sustainable energy, right? So if you want to buy into a SPAC that could potentially merge with, like, I don't know, an EV company, because those are all the rage these days, well, then maybe you should look for a SPAC that's specifically with the goal in mind of looking for a company in the, you know, sustainable energy space to like buy into, right? But yeah, anyways, do your research. That is my point. But for the sake of time, I'm going to talk about one SPAC, and one SPAC only today, that I find personally particularly interesting. And that has got to be Pershing Square Tontine, ticker symbol PSTH. Now, this is Bill Ackman's SPAC. Now, Bill Ackman, if you don't know who he is, he's a hedge fund manager, and he's made quite a bit of money when the stock market crashed back in March. Let me just say that. Right? So, you know, now that the SPAC that he created is actually the largest SPAC ever in history, at a record-shattering $4 billion. As I mentioned earlier, most SPACs are under $1 billion, right? So, you know, for reference, this one is like absolutely huge. This thing is just absolutely enormous. That's what she said. And this SPAC is set up a little bit differently, where the intrinsic value is actually $20 per share, as opposed to $10 per share. So, you know, if you're wondering why the stock is so high without a deal, that's why. And there's also a lot of other structural differences between Pershing Square and the regular SPACs that I'm not going to get into, but I'll link a video down below to someone named Patrick Desjardins, who did a very good video explaining all the features of Pershing Square and how it's different than a regular SPAC. So please check out Patrick's video if you want to find out more details, and he can explain it a lot better than I can. Anyways, so people have been speculating on what the merger target could be, and a lot of people were saying Airbnb. Now, that would have been a really good match in my opinion, but unfortunately, it looks like the management of Airbnb, they don't want to do a SPAC merger IPO, right? They want to do a traditional IPO, so they turned down Ackman, which is actually kind of sad. It's like, you know, that moment when you like a girl and you ask her out, but she doesn't like you back and she turned you down? Yeah, that happened to Ackman. So I'm sure we have all been there. What are you going to do, right? So that's kind of sad. But we gotta move on, right? So I've heard other candidates being proposed, and this is just random rumors on Reddit, by the way. I'm saying this without a shred of evidence whatsoever, so please don't take this to heart. But, you know, I've heard rumors of Stripe, which is this payment processing company, Chick-fil-A, which would be nice, but I heard that they don't want to do, like, they don't want to go public ever, right? Or In-N-Out, which could be interesting, which is, you know, In-N-Out burgers. I'm sure a lot of you have been to In-N-Out. Robinhood, which would be very interesting. Or I've even heard SpaceX, which, come on, guys, like, dream on, right? Like, it's not going to be SpaceX. I can tell you that, right? So all the other candidates, maybe possible, right? But SpaceX, like, I wish it was SpaceX. Come on, like, you guys know me, right? You guys know I'm a big Tesla shareholder. I would love to be able to buy into SpaceX, and I would buy SpaceX stock all day, every day, if I could. But it's not going to be SpaceX. But it would be nice, though. But it could also be something that we never even heard of. You never know with these things, right? But whatever it is, I do think that it's going to be something good. I do think that Ackman will probably pick something good. And I do think that the chance of this SPAC failing is actually relatively low. And the reason for this is just because I think that would be kind of embarrassing if this SPAC were just to fail, right? Could you imagine if Bill Ackman just got on stage and be like, oh, we've assembled the largest SPAC in history, and then like a year later it fails and it dissolves, right? So I don't think that Ackman will let that happen. And if you know anything about Bill Ackman, he's got, quite a bit of ego, let's be honest, right? So I don't think that his ego would just let him like live this one down if this SPAC were to fail. So I do think that there's a lot of pressure on him to pick something good. And I do think that there's a lot of pressure from like Wall Street and investors in general for him to pick something really good. So I do think that this will be a really successful SPAC, and whatever he picks is going to be something good. And on this fact, I'll probably pick up some Pershing Square Tontine very soon. Not a recommendation for you to buy it, by the way. Don't take investment advice from some random guy on YouTube, once again. Anyways, the video is getting super long, so I'll leave it here. Be sure to hit the like button if you enjoyed the video, and consider subscribing if you like the series. Be sure to follow me on Twitter and Instagram, links down below in the description as always. And with that being said, I'll see you guys in the next video. Bye-bye.